This stock investing strategy returned over 20% annualized return, crushing the market, turning $10,000 into over $7 million using one number. That number is the value creation yield. We see it's the ROIC, the return on invested capital of a business, divided by the hype factor. The ROIC, return on invested capital, tells us how well the business is turning invested capital into profits. Is it a money-making machine? Is it a high-quality business? We want ROIC to be high. The hype factor is telling us how the market values that invested capital. It's the multiple the market is willing to pay, similar to a price-to-book ratio. So a high hype factor means high hype, a high ROIC means high quality, and for the value creation yield, that combination as a percentage favors a high ROIC and a low hype factor. Great companies at non-bubble prices. So why is the value creation yield so powerful? Let's take a look at an example here. This is Google, and we're plotting throughout Google stock's entire history the value creation yield on the horizontal axis, and on the vertical axis, the 3-year annualized stock return. And we see some outliers, but there's a clear trend here. The larger the value creation yield, the larger the stock returns over the following 3 years. Now, this is just one example. To really prove the power of this metric, we need to do a backtest. So here we're doing a backtest over the past 36 years, going back to 1990, getting thousands of stocks, filtering them according to a value creation yield, for this case, above 15%, and comparing that with the S&P 500. We're using valueglance.com to do the backtest for us, and we see a fantastic result. Our value creation yield strategy here in brown returned 20.3% annualized. That turned $1 into over $700. The S&P 500 over that time period was about 8 or 9%, 11% if we reinvest dividends. It's not even close. This simple strategy beat the market over the long run using one number, because it combines key fundamental metrics for quality and value. So keep it simple, a diversified portfolio of high quality stocks at reasonable, non-bubble prices wins the long game. That's the money printing machine that can compound wealth for the long term.